Good morning, everybody. Welcome to our retirement planning webinar this morning. Just going to wait a couple of seconds to let everybody come in from onto the screen so we can get things started. All right. I think that should be enough time. Let's get everything rolling. Just to introduce myself to begin with, my name is Bill Thompson. I'm the Brisbane Relationship Management Manager here at Australian Catholic Superannuation. Got one of our best with me today to help present, Tom Rouse, who's a part of our financial planning team, and also want to put a mention through for Justin, who's in the background making sure that everything runs smoothly this morning. I'm just going to kick things off with a welcome to country. I would like to acknowledge the traditional custodians of the land on which I work and live, recognise their continuing connection to land, water and community, and I also like to pay respects to elders past, present and emerging. Just a little bit of administration to begin with. We do need to provide this disclaimer. I just want to advise that this is general information only. It is not advice because we won't be taking into consideration your personal circumstances. So please, if you want to implement anything that we discuss with you today, expect you to do a little bit more research. There's a copy of our product disclosure statement and our FSG available from our website. And should you wish to, or if you have any questions as we progress through our presentation today, if you go up to the controls, you'll see a Q&A section. So if you send those through, Justin's monitoring that. And if we get a chance, we'll go through any of those questions progressively or at the end. But if we don't get time, just know that someone from our relationship management team will actually reach out to you in the next 24 to 48 hours and make sure that you have everything that you need to progress on any ideas that you do have. We are going to try and stick to the hour and a half today, so we will get through that as efficiently as we possibly can. Hopefully, and for those of you that are in lockdown, regrettably, hopefully we can keep you entertained a little for the next hour and a half at least. So we're going to start off just having a little bit of a chat around our retirement goals. So obviously, whatever you want to do in retirement will largely impact how much you need to save for that retirement and what that looks like when you do get there. Travel obviously being one of them, depending upon where you want to travel, or in today's day and age, where you can travel, is going to largely depend on how costly that might be. My mum, for example, she's got a tent that she just throws in the back of the car, and she's more than content to just head out bush for a little bit and get away from the daily grind. But others of you might be a little bit more inclined to go overseas or do cruises, maybe not cruises in the current environment, but lots of different things there. So depends on how you'd really like to spend that time. I know Tom's going to probably mention his mother-in-law a little bit throughout this presentation. Tom, any thoughts on what your mother-in-law would like to get up to during
you know me too well. You know me too well, Bill. No, so I guess whenever we're talking to clients, especially, it always comes back to what do you want to achieve. So as you've already mentioned, there's lots of different things that people want to do in retirement. Then I guess what we've got to try and do is quantify that. So we've got to quantify that into a kind of financial goal. So whether it be travel or family time, then we can convert that to a financial goal, and then we can plan for that. But yes, my mother-in-law retired recently, moved up to Queensland to retire. Her main goal is that she wants to maintain her lifestyle. So that was what we'd converted to try and make sure that she's got the income to maintain the lifestyle that she had while she was still working. So come back to that.
Probably fair to say she's timed that quite well considering the current environment.
Very lucky.
So I guess that then leads us into how much you might need in retirement to live off. And I've got some examples on our screen in front of us there in terms of what might be available to you depending upon your circumstances. On the left-hand side, obviously, we've got what is a full age pension, whether or not that's for a single or a couple, and how much that allows you to live off. But we've also got this Association of Superannuation Funds Australia do some research, and they've, I guess, identified a couple of other lifestyle options with regards to the modest and the comfortable that obviously are a slightly higher standard. But we're going to go through exactly how you might be able to support those lifestyles with not just the age pension potentially, but also making up the difference with your superannuation or any other investments that you might have out there. Give you a little bit of an example of what those lifestyles look like. We've got this directly from the ASPA website, and it kind of goes through some practical examples of what those lifestyles do looks like. We've got the comfortable on the left-hand side. So it's actually looking at, having some decent holidays in retirement, owning a reasonable car. You're not going to be stretched to replace clothes, for example. If you need to do some work around the house, that's also going to be an option. Not every day, obviously, but over time. And probably an important one, Tom, for us is private health insurance. Me in particular, starting to fall apart now. So when I get a little bit older, that's definitely going to be something that plays into my thinking.
Yeah, that's right. I mean, whenever I, again, speak to clients, what's comfortable to one client can be very different to another. So all I would say is have a look at your current situation and see, well, do those figures of that modest or that comfortable amount, does that match your current lifestyle? Is it more than, less than? And then you need to think, okay, well, do we have to make an adjustment in retirement? So it always comes back to the individual and what's comfortable for them. So, because I see clients say, look at that comfortable $65,000 for a couple, for example, and they go, well, that's more than enough for us. Whereas for other couples, it might be, well, actually, we do like to eat out a bit more. We do like to travel a bit more. And that's where they might need the $70,000, $80,000, $90,000 a year. So it all depends upon what you're wanting as well.
Yeah. Understandable. And I guess if I think back to my university days, I've lived off a lot less than that in my time as well. Not that I'd suggested that was comfortable at the time. I guess the other element of it is that certainly superannuation will be the largest single asset outside of our home that most of us do have. But Tom, it's not exactly the entirety of our retirement plan, is it?
That's right. So whenever we're looking at retirement plans as a financial advisor, we always look at the holistic view. So yes, we work for a super fund, but we as advisors, we also look at, well, what else do you have potentially to help fund your retirement, and how can we plan with that? So again, going back to my mother-in-law as an example, she didn't have a lot of super because she worked part-time most of her life, and her kind of goal was, again, to maintain that lifestyle, so the income. So what we ended up deciding doing was using the family home and downsizing, and then adding that to her super to be able to give her the income that she wants in retirement to be able to continue doing what she wants to do. So not for everybody, but these are the sorts of things that we discuss, we look at, and we kind of put all these pieces of the puzzle together to meet any goals in the best way.
Definitely. And we're going to touch base a little bit further as we go through in terms of how you might use the family home and other elements of that to fund that retirement. But being a superannuation fund, let's start with what we know, and talk you through some of the tax benefits of saving within superannuation. So superannuation, anything that's contributed to your superannuation on a concessional basis, so that includes your employer contributions or your salary sacrifice, or if you do personal deductible, is only taxed at 15%. Depending upon your salary and your marginal tax rate, you can certainly see how that would be tax effective moving forward. Transition to retirement in recent times has probably become a little less tax effective because of the change to the investment earnings now being taxed at 15%. But considering, again, marginal tax rate, that's definitely something that's worth considering. Once we've retired and we've reached our preservation age and we've set up an account-based pension, that entire situation is completely tax-free upon withdrawal, and your investment earnings are tax-free as well. So you can see that there's some real benefits for that. And I know, Tom, you probably described this quite well on this slide.
Yeah.
Whereas superannuation is a tax vehicle.
Exactly. So I guess the first thing whenever I see a client for the first time is to remember that super is not an investment. It's not like buying shares, buying an investment property. All super is a tax vehicle for investing. Why is it the best tax vehicle for retirees? It's all around, as you've already mentioned, Bill, how the investments are taxed and money going into super is taxed. Okay. The catch with super is always, when can I get it? So when can I access that money? But if you're approaching 60, and we're going to talk about this, but that's the golden age, 60, because that's when you can either access super in part tax-free or in full tax-free if you're retired. So that's why, as you approach 60 and 60 plus, really you should be thinking about super as the perfect vehicle for investing for retirement.
I've done the calculation, Tom. 13 years, 6 months and a few days.
There you go.
So
Countdown's on.
Not too excited. So just to give you a bit of an idea what that might look like, some of us are actually a little bit luckier, depending upon when we were born, where we could actually access our superannuation a little bit earlier than 60. So it has progressively been moving out for most of us so that we can access our superannuation from 60. And what you need to have done at that point in time is essentially what's called your preservation age, which is a lovely term in superannuation. So once you've reached your preservation age and you're fully retired from the workforce, then you can access your superannuation at that point in time. The other element of that preservation age, and for those of us where it is between that 60 and 64, is that you can access your money through a transition to retirement allocated pension at that point as well, which can give you access to up to 10% of whatever you use in that account. Also, once you reach 60 and between 60 and 64 and you change an employment arrangement, so you go from one employer to another, you can also access everything that's in your account at that point in time. So that's another way that you can access your superannuation as well. 65, I know, Tom, you refer to that as the magical age for superannuation, where there are no restrictions whatsoever on your access to the money that's sitting in your superannuation.
Yeah, that's right. So I guess the key takeaway from these ages, generally speaking, if your preservation age, which for some people, they can access super earlier than 60, we don't often see people access it now because of just the way that it's taxed, because there can be tax implications. So generally speaking, people look at waiting to age 60, and because 60 is the key age, and where super's tax-free, and then 65. So I guess you've got to be thinking about these key milestones, that if you're approaching 60 or you're over 60 or you're turning 65, what are we doing around our super? Because there are lots of options available to be able to plan for the future.
Yep, no, that's perfect. So if we have a look at those tax benefits again in terms of putting money into your superannuation, salary sacrifice is one of those key vehicles where people take advantage of that marginal tax rate and the concessions that go into superannuation to take advantage of that. So as you can see on this table in front of us, if you're earning up to 45,000, then you're paying 19% marginal tax rate. Compared to the 15% that's available for money within superannuation. But it also, Tom, becomes a little bit more effective once you start earning over that $45,000 mark in terms of what you can save in getting that money into superannuation.
Yeah, that's right. So effectively, salary sacrifice is putting money into super before you've paid any income tax. There are limits, which we'll talk about. But if you think for every dollar that you earn over $45,000, the government take 32.5 cents. It's actually 34.5 when you include the Medicare levy. Whereas if you put that into super, then the government only take 15% tax. So again, it all comes back to what is super? It's a tax vehicle that you can either have money in cash in hand, but they take the 34.5% tax for every dollar over 45,000, or putting it into super instantly, well, they've only taken 15% tax. So you've got more money there. And I think we've got an example, have we, Bill, in the next slide?
We certainly do.
Yeah. So just to explain this one. So what we've done here is, I guess, just a full-time teacher at the top level is a typical client that we look at. So obviously it's not everybody, but effectively, if that teacher put 5% of their salary into superannuation as a salary sacrifice, that would mean an additional contribution of $192 taken from their pay. So yes, their take-home pay will drop, but it will only drop by about $127 because of the tax difference. So effectively, what they can do is they can save an extra $66 per fortnight in their super, rather than have that $127 as take-home pay. So again, not for everybody, because you might need that $127 to do other things, live life, pay debt, etc. But it's definitely something to think about, because that's a guaranteed return on your money. That's not an if or maybe a but. That pure tax difference is a guaranteed return on putting that money into super. And if you look at it, it's actually about a 30% return in percentage terms. The catch, again, coming back to the catch, any money that you put into super is locked away, it's preserved until you meet one of those conditions of release of when you can access your super. So that's always the catch.
And 17,000 over 10 years, I'd like to get that away so that my boys can't access it. Expensive little creatures that they are. Tom mentioned that there are some limitations in terms of what you can get into superannuation. So we'll talk a little bit about concessional contributions, and I touched base briefly on what they were. So that includes anything that your employer contributes, which is basically the superannuation guarantee. They may be doing additional contributions depending upon where you are. And those are also included. Anything that you salary sacrifice is considered a concessional contribution. And I'm hoping that most of you are aware that if you contribute money directly to your superannuation and claim a deduction on that, it's called a personal deductible contribution. And that's also considered concessional. So from 1 July this year, that rate went from $25,000 to $27,500 per year. And as we've mentioned, that's all taxed at 15% upon entry. If you're on a higher salary of $250,000, then that concessional contribution is taxed at 30%. But not too many of us are in that particular realm. But if you are, that's fantastic news. Just a little anomaly, I suppose, with this one. If you have not used your full cap space from 1 July 2018, then you may be able to bring those forward and actually contribute a little bit extra as well. Have you been using that at this point in time much, Tom?
Yeah, so I guess that rule which was recently introduced, Bill, it's called the carry forward rule for concessional contributions. So it is a bit tricky to work out, but if you ever have a MyGov account and you log into the tax office section of your MyGov account, it's very transparent now. They actually tell you if you do have any unused cap from previous years. So what that means is that your personal concessional contribution cap might be more than that $27,500 if you've got concessional contributions that you can carry forward. I mean, I guess they brought this rule in because what they want to encourage is that $27,500. It's not a lot in an individual year, and often people focus on either paying down debt or they're raising kids in their younger years. So it allows them to put more money into super tax effectively once they do have that surplus cash flow when the debt's paid off or when the kids have grown up and they're not paying the school fees anymore. So they can use that previous unused cap. Two caveats. Number one, it only carries forward for 5 years. So there is a limit on what you can carry forward. And number two, you can only use the carry forward provision if your total super balance, so that's all your monies within superannuation, is less than $500,000. So again, you can find those figures out from the ATO, but that's something definitely that we can plan for. Give you an example, had a client last year, paid off their debt, and they weren't aware of this rule. And we used the previous 2 financial years of unused cap. And I think her tax return was $15,000 that she got from last year. So it can be quite significant in planning for this. So it's definitely something to look at if it's an option for you.
Worthwhile if you can.
Mm.
The other type of contribution that you can make is actually considered non-concessional, and other people might refer to this as after tax. So you've already paid tax on that. Again, there are limitations into what you can contribute to your super. If you're under 67 years of age, from 1 July, you can actually contribute up to $110,000 per year. but you can also use 3 years worth over any 3-year period. So that allows you to access up to $330,000 in the first year, and then you would be unable to contribute anything extra for the subsequent 2 years. So that's a new rule from 1 July this year, where the government's allowed people that are all the way up to age 67 to be able to do that. Once we reach age 67 through until 74, you are limited to $110,000 per year, and you also need to use the work test, which for those of you that haven't been in that realm before, you essentially need to work 40 hours within 30 consecutive days at some stage during that financial year to be eligible to contribute extra to your superannuation. Unfortunately, once you're over age 75, hopefully you're not still working, but if you are, unfortunately, you can't put any non-concessional contributions in at all. So that's somewhat of a limitation. Tom, am I right in saying that there's also limitations in terms of your account balance impacting whether or not you can use this full 110,000 or the bring forward rule?
Yeah, 100%, Bill. So if you're in a lucky position where your super balance is $1.7 million or more, that then you can't actually make any after-tax contributions to super. So a total super balance of what you can have within super before you can they stop you putting extra contributions in. Doesn't mean that the employer or salary sacrifice contributions can't go in. They can still go in. But if you have more than the 1.7 million, that's where you can't put these after-tax contributions in. The caveat to that is that you can use the downsizer rule, though. So I think we're going to talk about that shortly, but the downsizer rule is actually separate to these limits and isn't subject as well to that total super balance of 1.7 million.
We're having some technical difficulties. Let's jump forward. My apologies. Just while I'm trying to fix that up, Tom, would you mind just going into that downsizer contributions?
Yes, so basically the downsizer rule, which there are proposals to change that as well. But currently what the rule states is that if you're over 65 and you've lived in your own home for more than 10 years, and it's your own place, primary place of residence, that if you have surplus cash from the sale of the home, you can put up to $300,000 into super, and that's $300,000 each if you're a member of a couple, from the sale of that home, and put it into super to top up your super. So again, that's effectively what my mother-in-law did to help top up her super. As we've mentioned, there's no age limits, upper age limits, so you can do it whenever you want. It doesn't count towards any other limits, so that non-concessional limit or the concessional limit that we've talked about, it's a totally separate limit to that. And also, if you do have more than 1.6 million in super, sorry, 1.7 million now, that you can still put that contribution into superannuation phase under that downsizer rule.
Tough situation to be in if you've got 1.7 in superannuation.
These are nice problems to have. So.
My sympathies are restricted. A couple of the other ways that you can actually contribute to superannuation as well, there's something called a spousal contribution. So if your spouse meets certain conditions and you contribute superannuation to their account on their behalf, you may be entitled to a tax offset that's going to help you reduce your tax burden as well. And of course, consolidation. It's something that's been described across the industry plenty of times. Most of us may have one account now, but I think the average Australian has a little over 2 accounts. So consolidating can save you on fees, and that includes administration fees and potentially insurance premiums as well. A good space to go into to investigate whether or not you've got multiple accounts is your MyGov account. Tom's already mentioned it in terms of your contribution options, but your MyGov account will also indicate whether or not you've got other accounts, because everything's linked to your tax file number, of course. So that's a consideration as well. Just be aware, if you do close an account and you had insurances in that account, those insurances would become null and void at the time that you close the account. So just make sure that you make that informed decision before taking any steps in that space. talking a little bit about how you can access your superannuation. A couple of different options. You can obviously take a lump sum. So at the time that you've met a condition of release, you can withdraw an amount from your super as a lump sum, whether or not that's to purchase a car or if you're paying off part of your mortgage or anything along those lines. But the other, probably more regular option, is to set up an income stream. So Tom, I know you're going to go into a lot more detail about how that might work for someone.
Yeah, exactly. So with an income stream, effectively, I guess you're accumulating your super over your working life. So you're putting contributions in, and then once you retire, then you've got to go, okay, well, how are we supplementing our income once we retired and there's no more employment income? So generally speaking, that's where people look at income streams, where they provide a regular income, and basically you become your own employer. So you can choose how much you want to get paid. When you do start an income stream, there are rules around a minimum payment that you have to take from that income stream. Currently, because of COVID, those minimum payments have been halved. So if you're between the ages of 60 and 64, the minimum payment is 2%, and that will be going up to 4% from the 1st of July next year. And then if you're 65 to 75, it's 2.5%, currently going up to 5% from the 1st of July next year. So they do have those rules. But if you're retired, there's no upper limit on how much you can take. So you can basically pay yourself what you want, but obviously the more you pay yourself, the quicker it goes. But that's a nice, easy way to just supplement your income needs. If you ever want to take lump sum withdrawals from those income streams, they're very flexible, that you can dip into it. It's a bit like a bank account once you're retired. And as long as you're over 60, all those payments are tax-free. You don't have to put them in a tax return. Again, there are caveats. The only caveat that I would have regarding starting an income stream is if Centrelink are involved in your life. So that might be where you have a partner that might be on Centrelink, or you might be looking at Centrelink. Then just be aware, depending upon your age, will depend upon, well, do Centrelink count your asset, that income stream as an asset? Whereas if you leave it in super and if you're under a certain age, they might not count it as an asset. So just be careful there about what you're doing. So again, that's what we plan for all the time, is, okay, what is good for your situation to meet your goals and objectives.
So Tom, I guess this is indicating when you can start a pension, or in some cases a transition to retirement allocated pension. And we mentioned this briefly on an earlier slide, where some may be 58 or 59 and can access their superannuation through a transition to retirement or through full retirement now. What is going on? Apologies, everybody.
Seems a bit trigger happy.
I'm not even touching anything.
So yeah, I guess I'll pick it up, Bill, that yes, you're right. So transition to retirement can be quite important going into retirement, and how do we use these income streams to help? So you're right, you can, if you're at 58 or 59 currently, that you can access your super through transition to retirement. Again, there are limits on what you can do. So the maximum that you can take from your super while you're still working, but you've met that preservation age, is 10% of the account balance each year. If you're over 60, then those payments are tax-free. So that's why, generally speaking, people look at waiting to 60 to access their super, because they know it's guaranteed to be tax-free. Whereas before 60, 58, 59, there are some tax implications. So generally people are hanging off that 1 or 2 years. But why would you want to access your super early? In terms of, well, I'm still working full time, I've still got income coming in. Why would I want to start a transition to retirement income stream? Well, there are the 3 main reasons. One, that you want to reduce your working hours, but you still want to maintain your lifestyle. So it can help top up any income that is reduced from less hours. 2, we've already talked about salary sacrifice into super, which is great, but it reduces your take-home pay. So this is where, if you can't afford to reduce your take-home pay because you still need the money to live on and pay bills and pay debt, that, well, you can still do the contributions to super, the salary sacrifice, and use the transition to retirement income stream to withdraw money tax-free and make sure you've still got the same total level of income, but you've reduced your income tax bill. So that's another way that we can use the transition to retirement income stream to help people. And then the third thing that we look at when we're looking at for clients is, well, do you want to pay down debt quicker? There are some clients that I have where they've still got quite a bit of the debt on the mortgage. They're worried about that at the age of 60, and they want to be debt-free by the time they retire. And there are ways that you can use that income stream if you're wanting to look at paying down your debt quicker. So those are the three main kind of strategies that we look at for that transition to retirement income stream. It's not for everybody, but definitely, as I say, once you turn 60, your options become more open. There's so many more options about what you can do with your super.
I think the one thing that I'd add to that, Tom, is that if you're looking for that sweet spot, I suppose, in terms of that transition to retirement, where you're essentially building up your wealth over time, or that paying that down that debt, there's real value, I think, in actually having a chat to a financial advisor to help you do those calculations and make sure whatever you do set up is working as efficiently as it possibly can for you.
Yes, exactly. Yeah, so that's what we look at, and the things change in life as well. So I have clients that say, look, we're going to be working full time the next couple of years, and they come back to me in 6 months and say, Tom, I've gone 3 days a week. What do we do now? So that we need to think about that flexibility.
Now, the other element of that income stream is we have a couple of options here at Australia Catholic Super. So, Tom, I'll get you to go through the differences.
Yes, so with Australian Catholic Super, they do offer a product called Retired Choice and Retire Smart. So the Retired Choice income stream, as it says with the name, is that you can choose where your money's invested. So just like your superannuation account, you have a choice of many different investment options. So the Retired Choice income stream works exactly the same, that you've got the same choices of the investments to choose from. So that's where if people want to take a very low risk, they can choose a very low risk investment. If they want to put everything in the share market, they can do that as well. You can choose all 13 different investment options. I wouldn't recommend it, but ultimately you have control. Okay. The Retire Smart product, which the fund has developed, is more, I guess, a let the fund decide on how they're managing the money for you. Okay, so what the fund do is they go, okay, well, we're going to put your money into 2 buckets. One's called a growth bucket and one's called a cash bucket. With the growth bucket, that's where they'll put the majority of your money. And in the cash bucket, they put 2 years worth of your pension payments. So you have to tell the super fund, okay, well, I want to be paid 5% a year. And then what they'll do is they'll say, okay, well, if you want 5% a year, we'll put 10% of your money in that cash bucket. Then what happens is, well, from the growth assets that are invested, any income that generates goes back to top up your cash bucket. And then you're receiving your pension payments from that cash bucket. So it's kind of automatically managed for you by the fund to make sure that, well, that cash bucket is topped up as much as possible every year, and that you're receiving your payments from that cash account. The only thing I would say about that Retire Smart product is if you do have quite a lot of your money in that growth asset side of things, you've got to be prepared or tolerant towards quite larger fluctuations in your overall super balance. So it is a product that's more suited to, I would say, a person that is willing to take more medium to high levels of risk with their super in retirement. So just be careful of that. Generally speaking, the clients that I see, they want to be a bit more cautious with their money. So if they want to be a bit more cautious and not see that volatility, then maybe the Retired Choice product might be more suitable. So but then you've got to manage that investment within the Retired Choice product. So there's pros and cons to both, but definitely something to think about. And it just gives options to our members, Bill.
I suppose with Retired Choice, if you like the theory behind the Retire Smart option, you can replicate that somewhat within the Retired Choice as well, can't you?
That's right. You just have to, it's not automatically managed for you. That's
Sure,
the main
mate.
difference. So Retire Smart, the fund will automatically do all this cash distribution, make sure your cash bucket is topped up for your pension payments to be received.
Look, before we head on to the age pension element of retirement, Julie's actually posted a good question for us. I think is worth answering now, and that question is: how long does it take to set up a pension account, and when should you contact the superannuation fund to get that set up? Julie, I guess from an administrative point of view, you're probably best to allow 5 to 10 working days prior to you needing the money to be able to get that set up, because it does take a little while around the investments and selling assets and those sorts of things. So I would generally suggest 5 to 10 working days. But certainly in the lead up to you considering setting up a pension, again, it's worthwhile just seeking some information directly from the superannuation fund, just to make sure that it does get set up, or it does exactly what you're hoping for it to do. Tom, we've talked a lot about superannuation and then how we can access it and those sorts of things. But another key element that a lot of people might be accessing is the age pension.
Yes. So I guess when I see clients, this is quite a big thing that we plan for is age pension entitlements. So the important thing to remember is, well, when am I entitled to the age pension? Because it's not automatically 65. A lot of people that I meet say, oh, isn't it 65? Well, we'll show you the actual, depends on when you were born. Obviously, you've got to meet residency requirements. And then the way that Centrelink, or well, they're actually called Services Australia now, I shouldn't call them Centrelink, assess your eligibility is always based on your assets and your income. So we're going to talk about those. And then depending upon that will depend upon how much you get paid. For 70% of people, though, who are retiring today, that age pension will form in some part of their retirement planning. So from the majority of Australians retiring today, that they will have some age pension entitlement over their retirement. So just going back to that age, so this was a major shock again to my mother-in-law when she turned 65, because she said, oh, I can go and apply for the pension now. She was actually born in February 54, and her age pension age was 66. So at the moment, if you're 66, then so born before the 1st of July 1955, you have attained age pension age. But if you're born between the 1st of July 55 and December 56, then your age pension age is 66 and a half. And then on or after the 1st of January 57, everybody's age pension age is 67. So you've just got to think about that, because if these are different to when you can access super. So that's also the confusion that I get is, okay, well, when can I access my super? Is it 65, 66, 67? So you've got full access to super from 65, whether you're retired or not. You can retire from 60 and access your super tax-free, but there wouldn't be any government support for most people until they turn 67. So whenever people say, well, when can I retire? You can retire when you want. You just got to have a plan to say, okay, well, how are we funding retirement if we retire at 60 and can't get the age pension to 67? And then what does it look like after 67? So just got to keep that in mind when we're thinking about planning for retirement. So with the age pension, what they do is they do 2 tests. So the first test, which generally once people are retired, is what Centrelink will look at, because for most people, it's the asset test which reduces their age pension. So for a single person, if you're a homeowner, then if you've got total assets of under $270,500, then that's where you're entitled to the full age pension. Now, the main asset that they don't count is the home. So you could have a $5 million home, $200,000 in the bank, you get the full age pension, okay? Every dollar, though, of assets that you've got above $270,500, they basically reduce the age pension on a sliding scale all the way until you get to $593,000. And once you've got assets of more than $593,000 that are accessible, that's when you're not entitled to the age pension, okay? For a non-home owner, they give you a bit of a higher threshold, okay, because you don't have a home. So they allow you a bit more assets before they either reduce the age pension or cancel the age pension. So when you're looking at assets, they're basically looking at money in the bank, shares, any second properties that you've got. They take the net value of that. So if you do have debt against the second property, they'll take that off the value of the property. One thing they don't take into account is if you've got debt on your own home. So because your own home isn't an asset, well, they're not going to take off the debt from your assets because your home. So one thing to think about is if you're pension age and you've got a debt on the home, well, do you pay it off? So because it reduces your assets for Centrelink. But money in super, they even count your car and your contents, okay? And then for a couple, basically, you've got a bit of a higher threshold as a couple. So if you're a homeowner, 405,000. If you've got under that, that's when you've got the full age pension. And then the upper limit now has gone up to 891,500. So the other thing is these limits do increase every 6 months slightly with inflation. So it might be that I've seen clients where they've had $900,000 of assets 1 year, and then the limit has increased and their assets have come down a bit and they might have just got under the threshold. So it's important to review your situation as well, even in retirement. So that's for the assets for a couple. Again, they don't count your own home as a couple. And the other asset that they don't count is if you've got a member of if you're a member of a couple and your spouse is under age pension age, then any money in superannuation is not counted as an asset either. So it's very important though that it's in superannuation phase, because if it's converted to an income stream, then that's where they start counting that asset towards the assets test. But it is a strategy, especially if you're a member of a couple where one will attain pension age first, and then the younger spouse might not attain it for 1, 2, 3, 4, 5 years, that moving money into a younger spouse's superannuation can be a strategy to look at to try to improve any age pension entitlements for a period of time. Again, there are limits on what you can do, but this is what we plan for when we're looking at planning for retirement.
Makes sense, as long as I trust my partner at the time.
Well, these are what we discussed, with that there are other issues, so it's not for everybody. So yes,
I think I was going to say, Tom, one of the important things I think it's key to remember is that your circumstances will change even in retirement. And I just want to make it perfectly clear that though you may not meet the age pension assets or the income test at the time that you first retire, as you work through those assets progressively, there may become a time when you actually are eligible.
Exactly. And also rules change. So one of the big rule changes, which actually happened back on the 1st of July 2019, was around how Centrelink treat lifetime income streams. So we've talked about account-based income streams, which the fund offers, but there are other products out there, such as lifetime income streams, which work a bit differently. But because Centrelink treat them differently, then for some clients, it might be suitable for them to look at these sorts of products, because it can help with their retirement, but also if they're wanting to look at maximizing any age pension entitlements, it can help do that as well. So definitely you need to, even in retirement, keep looking at your situation, because yes, your situation changes, but also legislation changes. So I've been encouraging a lot of my clients that come and see me regularly. We talk about this major change that happened on the 1st of July 2019 around different types of income streams. So it is something just to make sure that you keep looking at and reviewing even in retirement. So I guess that's the assets test, which, as we mentioned, most people who have retired, they don't have any employment income coming in. That's what they'll be on. Then what we look at, or what Centrelink look at, is the income test. So what they do here is, again, if you're a single or a couple, they look at the income coming in And depending upon that, they go, okay, well, how much are you entitled to in age pension? For most people, if you're still working, that's going to be your major income. Now, if you're over age pension age, you can actually earn $350 a fortnight, and they don't actually count the first $350 a fortnight that you earn towards this income test. So that's the first thing. Then any income that is counted, and if you're single and it's above $180 a fortnight and up to $2,115 a fortnight, then there might be a part age pension that you might be eligible for, even under the income test. And again, for couples, it's a bit higher, $320 a fortnight, up to $3,237 a fortnight. These figures, it's important to remember, they always look at your gross salary. They don't look at it after tax or after salary sacrifice. That's the first thing. And then they also add to this income any deemed income that you might earn from financial investment. So if you've got money in super or money in an account-based pension, which is counted towards the assets test, then what the Centrelink do is they deem that money, which is a very boring test. It's basically 2.5%. And then they say, well, that's what your income is from that asset. They don't actually look at what you're getting. So you might be getting more money from that investment or less. But they just assume, well, that's what you're getting. And then they add that to the income. I guess the main thing to remember from this bill is that just because you're working doesn't mean you're not necessarily entitled to age pension. I get it all the time where clients just assume, well, I'm working 2-3 days a week. Surely I'm not entitled to an age pension. Not the case. It depends upon your assets and your income. So I've had clients where I've said, well, actually, you're eligible for $50 a fortnight, and you get the age pension card because of your situation. And they were very surprised by that. I've had clients where the partner, they're both over age pension age, the partner's not working, the one partner's working, they've only applied for the pension for the partner not working, they're getting the age pension. But the thing is, whatever the partner gets, you get, because they always assess you as a couple. So that's where, if your partner's eligible for an age pension, you're eligible for an age pension. So it's important to look at your situation.
Tom, maybe worthwhile just explaining how they interact together, the income test and the assets test.
Yeah, good point, Bill. So what they do is they actually apply them separately. So they go, okay, under the assets test, what are you entitled to receive? And then they calculate it. And they go, okay, under the income test, what are you entitled to receive? And they go, okay, well, this is what you're entitled to receive. And then they're so generous that they pay you the lower of those two amounts. Okay, so it might be that, well, under the assets test, you qualify, and there's some payment, but under the income test, well, it's null and void, that you get a zero payment, so they'll pay you nothing, or vice versa. So they actually apply those tests separately and then pay you the lesser of the two amounts. But the amount they pay you will, as we've probably previously shown on a slide, I think it's on the next one, is the actual payment rates that we get. At most, for a single person, it's just over 25,000 a year, and for a couple, it's just under 38. And if you're a member of a couple where one is above age pension age, one is below, they don't pay you the single rate, they will pay you half of the couple rate. So the maximum that a member of a couple can get individually is just under 19,000, unless you're apart due to ill health, and that's where they'll pay you the single rate if you're a member of a couple that is apart due to ill health. But that's the main thing to remember. That's the maximum payment that you're going to get from Centrelink, depending upon your assets and income. So for most people, that's where your super, other assets are there to top up any age pension entitlement to give you that more comfortable lifestyle that you want in retirement.
Tom, we've had a recent change within the company itself as well. I know from a financial advisor perspective, one of your roles is to make sure that people get the most of their entitlement for the age pension. Am I speaking out of turn when I suggest that you can actually help them through the process as well now?
Oh yes, yes, that's exactly right. So it's a kind of a service that we're offering for our advice clients. So people who actually get advice, and the age pension is part of that advice. That we got a lot of feedback that it was the only thing that we weren't helping them with. We do a lot of implementation for clients, so helping them set up pensions, income streams, moving money around to maximise. But the clients actually going to Centrelink and applying, they still found it very confusing. Centrelink now want you to do everything online. So we've actually started a service where we will help those clients that have had advice. It's at a separate meeting, and we charge $390 as a one-off fee to basically go through the application, put the application in for them, and help them with the paperwork. So generally speaking, we do that with them online. So whether that be, well, luckily in Queensland, I've been doing it face-to-face with clients because it's a lot easier face-to-face. But I have done it with a couple of clients in New South Wales where we've done it via Zoom, and we've kind of done this screen sharing. So it is a bit more tricky, but the main thing is understanding what Centrelink are trying to ask, because sometimes it can be quite complicated, and just because you put an application in and Centrelink say, well, this is the result, doesn't necessarily mean that that's correct. Okay, that human error happens all the time. I actually had one last week where we put the application in, and this is one that I helped with, and Centrelink came back and said, okay, well, you don't have any entitlement. And I knew that was incorrect because we planned through some certain income streams to make sure that their assets were just below the threshold. And I pointed this out to Centrelink when we got on the phone to them, and they said, apologies, we made an error. We counted that under a different category, and yes, you are entitled. But that if the client was just doing that themselves, they wouldn't know. They would have just accepted what Centrelink told them. So again, having advice and doing this can be a good way to make sure that you get what you're entitled to.
Thank you, Tom. I'm not sure we should be bragging about our level of freedom up here in Queensland,
Well,
but you're
yes,
probably lucky that this is a Zoom meeting and people can't throw things at you. I apologise on Tom's behalf. There are some other elements to the seniors health card that people are still eligible for, even if they aren't eligible for the age pension. Is that right, Tom?
Yeah, exactly. So I guess, again, a lot of clients that I see, they don't necessarily want a lot of payment from Centrelink. They just want to get that pension card to get the discounts and to get the benefits that it can provide. So even $1 worth of age pension can give them that. I always talk about that there's this Commonwealth Seniors Health Card, that if you do have too many assets to the age pension, that because the Commonwealth Seniors Health Card isn't asset tested and it's only income tested, then for most people, once they finish work, because the deeming rates on their super and their investments is very low, that the majority of people will be under the income test for this seniors health card. So as you can see, for a couple, it's 92,000. For a single, it's 57,000. So doing a conversion for a couple, you need, I guess, about more than $3.6 million in financial assets before you're not eligible for this card. So the majority of people who aren't eligible for the age pension would be eligible for this Commonwealth Seniors Health Card, which basically gives you those discounts for bulk bill doctors, cheaper medicine, and so forth.
It's also fair to suggest that you, depending upon where you live, your state or territory government might also offer you some other benefits in terms of some lower rates and bills, or discounted public transport, which is also nothing to sneeze at. Tom, estate planning is often very, very confusing, I guess, within the superannuation environment, but there's a few bits and pieces that you do need to consider as we do get older, starting with a will.
Well, you speak to any lawyer, they'll always tell you as soon as you turn 18, you need a will. I don't know many 18-year-olds that have a will, but that's what they would say. But yeah, it is important, obviously, to have a will in place. I guess the main thing is that your superannuation does not automatically form part of your estate. Okay, a lot of people that I see, they think, well, my super will just go into my estate and distributed via the will. No. So super is actually what we call a non-estate asset, because technically you're not the owner of your super. You're a member or a beneficiary of a trust. So it's a trust structure, which is why it gets the tax benefits. So that's the legal technical structure of super. So that's why it's very important to actually tell the super fund and nominate a beneficiary of who you want that money to go to. Now, 99% of the time, we would always recommend making what we call a binding nomination on your super. So that basically means that the super fund has to pay that money according to a binding nomination. Now, under super law, there's only certain people that can be nominated as a binding nomination. Children of any age, the spouse, obviously, de facto partner, anybody in an interdependent relationship, or anybody who's financially dependent, or the estate. So you can actually nominate the estate as the beneficiary. So if you do that, then the super fund will just send a check to the estate, and then it will be distributed accordingly by the estate and executor. So for people who might not have children or a partner or anyone financially dependent on them, they can nominate their estate as a binding beneficiary. And then it's a lot simpler, quicker process. If you don't, then ultimately the super fund has to go through a claims process, and the super fund decides how that money is distributed, depending upon who might want to step forward to make a claim. The other thing about estate planning, I think people are becoming more aware of this, but Australia doesn't have a death tax. I mean, that was got rid of many years ago. But within superannuation, that there was a few changes again a few years ago about money passing to non-tax dependents, where what we call taxable super, it's very boring, but basically you have a taxable component of your super. If that gets paid on to non-tax dependents, which is generally adult children, then the government actually take up to 17% tax from that payment. So for some people, there are strategies where we can actually look at, if it's important to you, minimizing that tax potentially passing on to adult children. Two things. Number one, it doesn't benefit you because it will always be tax-free to you or tax-free to a spouse. And number two, you might spend all the money anyway, and it will never go to the kids, which is the plan for most people that I see. So, but for some people, that can be something that we plan for, is how do we minimize any potential estate tax for the kids.
So realistically, it depends on how well your kids have treated you growing up.
Very true.
Apparently no chance of me taking that particular step for them.
I've got time, Bill.
Well, it'd have to be a pretty quick U-turn. Now, I know one of the other services that's becoming a lot more prevalent in your space, Tom, is aged care. Very, very complex and often worthwhile reaching out for some assistance if you can.
Yeah, so again, a lot of people think I just deal with super. Not the case. I'm actually fully qualified to provide aged care advice. When we talk about aged care advice, we don't get into the realms of choosing a facility and negotiating with the facility about moving in. Our role is more around, well, how do we fund it in the best way? How do we make sure any care fees are paid for in the best way? Looking at making sure we preserve any estate values for the estate, because depending upon what you do, it can have a big impact on those three factors financially. So as you mentioned, it's not many of the clients that I see, because I mainly see the clients that are retiring and hopefully many years before they have to go into aged care. But I always have a conversation, oh, my mum's just about to go into aged care, or my dad's needing to look at a facility. And that's where we can help if people want to plan around the financial aspects of what to do going into aged care, because it can be very complex. So again, it's just to remember that we do more than just super when we're looking at advice.
You're on a roll, Tom. What else do you do?
Well, so yes, I mean, we've got here on the screen how we assist clients every day. So we've already talked about I guess that salary sacrifice, saving money for your retirement, looking at strategies to do that in the best way, making sure we stay within limits. I'll answer a question that just come through in a minute. Maximising Centrelink benefits. So that's quite important that we do. The biggest question we always get is, do I have enough? So this is where, whenever we do a plan, we always look at some scenarios and go, okay, well, depending upon budgets, when you retire, the investment risk you take, how long is your money likely to last, and interacting that with any potential age pension as well. So we do some quite detailed scenarios. And then the estate planning side of things is becoming more and more important because of the rules around the death tax on super, which I guess people make a decision on whether that's something important to them or not. And we always advise on non-super investments as well. So those clients that can't get money into super for whatever reason, and because of age limits, etc., that we do have advice on other investments that might be suitable for their situation. I just wanted to touch base, Bill, on a question from Ian Kelly, who's just talked about going over the contribution cap.
I was hoping you'd do that one.
Yeah, that's all right. So going over ideally, it's always better to stay under the contribution cap, because then you don't just get any letters from the tax office and it doesn't create.
Sorry, Tom, do you mind if I just break you there for a second?
Yep.
Because we're the only ones that can actually see that particular question, just to let everybody else know what's happened. Someone is contributing a significant amount to their superannuation on a personal basis. Last year they went over that $25,000 cap, and they're just asking what the consequences of that are, because they did have to pay some extra tax. So Tom's just going to touch base on what that looks like.
Okay, thanks, Bill. Yeah, so effectively, ideally, we'd always want to stay under. That's the first thing, because it just doesn't create any letters from the tax office or any issues. If somebody does go over the concessional cap, it's not the end of the world anymore, because effectively what the tax office do is they say, look, you've gone over the cap by X amount. You should have paid your marginal tax rate on it, 34%, 38, whatever it might have been, and you've only paid 15% on it through the super fund. So what they do is two things. They send you a bill for the difference of what you should have paid if you had it as take-home pay, and the 15% that you've already paid in super. And technically, because you've paid that tax a bit late, they do something called a excess concessional charge on it. So it's a little bit of a penalty. Now, generally speaking, if you do your tax return on time pretty much every year, that penalty is very small. But if you wait, because it's a percentage and it accrues at a daily rate, if the longer you do your tax return, the bigger that fine can be. So yes, they do charge a penalty on it if you go over that cap and you have to pay that excess contribution. The reason why I say it's better to stay under is because it can create a lot of knock-on effects and other issues with your non-concessional contribution cap. So if you're putting in large amounts, so I'm sure you've seen it all the time, Bill, where you get one letter from a member saying, I've got this letter, and then 2-3 months down the track, you get another letter from the tax office because it's interacted with their non-concessional cap. So it just can create a lot of other issues if you do go over the cap. So all I would say is, if you get a letter like that, come and have a chat, and we can explain your options about what you need to do. And then if you ultimately need to get advice on what to do, we can always help with that as well.
I think the other element of that, Tom, is that you've actually got a lot more personal control over how much you contribute to super now as well. So you may be in a position where you can contribute 30%, but if you were to reduce that, you still have that option to do the personal deductible contribution closer to the end of the financial year to, minimise the risk of going over.
That's right. Yeah. So there are other ways to manage it. Also, the $25,000 cap has automatically gone up to 27.5 this year. So you've got, I think for a lot of people last year, Bill, what they and I think I can't remember which employers it was, but there was actually 27 fortnightly pays in a couple of the dioceses, which is what happens once every 10 or 11 years, I think. So they actually put in an extra contribution than normal in that financial year. So that I've seen it quite a bit, that has, so people don't do it on purpose. It just happens because of these factors. There was also a back pay last year of super guarantee contributions for some people, which counted towards the cap. So these things which were unexpected can tilt you over without knowing it.
Yeah, exactly. While we're answering a couple of questions, William sent one through to Tom in terms of, is it permissible to set up a superannuation account for a spouse, and would we do that as a diversification practice?
So basically, anybody can set up a super account as long as you're allowed to make contributions, and I think you're over 14. But as a diversification practice, I think maybe I might be answering this wrong, William, but it can be beneficial to have money in spouses' names, and that might be around Centrelink. It might be around total super balances, how much you can get into super, because I guess these limits are based on individuals. So any limits on what you put into super are always based on an individual. Having $1.7 million in super is always based on an individual. So I see clients that are approaching that 1.7 million, and there are strategies. Well, you can move money into a spouse's name to make sure you take advantage of the total amount of money that you can have in super as a couple. So I think that's what you might be referring to, William. If you're not, we can get in contact you and maybe clarify in a bit more detail.
Spouse would probably appreciate it, though, I would think.
One spouse is always more happy than the other.
Now, just to go into a little bit more detail in terms of if you do need some extra information from us today, as I mentioned, we can have someone reach out to you in the next 24 to 48 hours, one of our regional managers, to offer you some additional services. But just to go through what our financial advice offerings are, we offer general advice. So that would be where someone like myself could give you a call and provide you with some factual and general advice in terms of your circumstances. We can't go into your personal circumstances, of course, but that might be suitable for some people that are financially savvy and comfortable with their decision. We also offer a level of over the phone advice. So this actually forms a part of your membership. So there's no additional costs to you for getting that over the phone advice. They do have limits in terms of what they can speak to you about. So they can absolutely provide you with personal advice in terms of your contribution strategy that A.M. Kelly, for example, expressed that question earlier, your contribution strategy, your insurance needs. Another one that's going to be topical when we go through some of our later slides, your investment option as well. And although there is a small fee associated with this, you could also have them help you calculate your transition to retirement strategy over the phone as well. Tom, off the top of my head, I've forgotten what the fee is for that transition to retirement strategy.
For the limited advice?
Correct.
Yeah, I believe it's $295.
Yeah. So still, and along with all of our advice, if we cannot add value in excess of that, then there's really no point in going to that advice. So if you have had a good listen to Tom, you'll know that he's very, very knowledgeable. Tom is one of our comprehensive financial advisors. So if you need someone to take a look at your holistic financial situation, I highly recommend Tom, and Sonia is the other one in our office, but we do have financial advisors right across the country that do a fantastic job. Like myself, they're salaried staff members, so there's no conflict of interest in terms of the advice that they do provide for you. They're going to provide you with advice that is in your best financial interest. So I would absolutely recommend that anyone and everyone reach out and take advantage of that. The beauty of our advice process too, Tom, is that your first appointment where we actually investigate your circumstances is free.
Yeah, that's right. So if you've not gone through the process before, effectively, we always sit down, it's usually about an hour, and go through your situation together. And then we can discuss, well, can we add value? Can we put you in a better position? If we can't, then a lot of the people, they just go, look, we're happy with the discussion, and we're happy just making our own decisions. But if I can, I would explain that, well, look, we need to look at this. This is what I can add. And that's where we can do a detailed plan only if you want to go through and say, okay, well, let's put a plan together to put you in that better position. So there is a fixed cost for doing that, because what you're doing is paying for my time, my professional opinion, and implementing the plan. So effectively, the fee covers the time that it takes to put that together. But as Bill's already mentioned, we would only do that if we could put you in a better position, because it doesn't benefit me. I get paid every fortnight, no more, no less. So that's the way that we've always worked, and that's why I love working where I do, because I don't feel like a salesman. So
perfect. I absolutely account. All of our financial advisors do a very, very good job, and I trust them implicitly. So I feel very, very comfortable when I do speak to clients that I recognise probably could use a little bit of advice, or when I send them through. So if you are interested in getting some further information following on from our presentation here this morning, I know Justin's actually going to put up a link for you where you can actually let us know where you would like, what sort of information you would like, and if you would like to get a financial advice appointment. So please take advantage and get that done, and we can get that rolling from there as well. Now, I think there is another question on there that's probably, I won't answer at this point in time, because it does kind of lead into financial advice, but I will let you know if we haven't answered your question this morning. We will be in touch in the next 24 to 48 hours, just to make sure that we do get you the information that you need. Now, one last little piece of the puzzle that I do need to discuss with you today is some legislative changes that have occurred very recently. You may have heard of those. It's quite topical, particularly in our environment at the moment, this Your Future, Your Super. Now, there are some different components to that, but the one I want to focus on with you this morning is the Your Future, Your Super performance test, which was first introduced during the federal budget announcement in October 2020. Lots of backwards and forwards in terms of lobbying from industry, from government, and different stakeholders, but ultimately it became legislated in June 2021, came into effect from 1 July, just gone. What that basically means is that government is going to introduce a performance test for superannuation funds. Specifically at this point in time, that's only going to cover MySuper superannuation funds. So MySuper, for those of you that aren't aware, essentially means that if you haven't nominated an investment choice at the time of joining the fund, then you are in our default product, or currently our MySuper default investment option. What has happened that on the 30th of August just gone, we were advised that our MySuper default investment option did not pass that mandated performance test. Couple of things to consider, I suppose, in that particular space. What the test does is it looks over the past 7 years of investment performance and compares our MySuper investment option against a predetermined benchmark. If those of you that have actually been engaged with your superannuation with us over a period of time, you'll know that our current default investment strategy is Lifetime One, but that strategy has only been around since 1 May 2018, so it's only been around for a few years. What's happened in terms of this particular test is the government has attached to those 3 years, 4 years of our previous default investment option, which is our conservative balanced option. So it's not an ideal scenario in terms of looking at a nice clean performance of our investment strategy that those that are in Lifetime One are going to be looking forward to into the future. There are 13 different investment choices that are available with our fund. So if you aren't interested, or you aren't in, or you are in Lifetime One and you'd actually like to make a switch out of that to something that has a little bit more or a little bit less risk, then we would encourage you to review that. One thing about this particular test is that we actually haven't even been notified of the exact position of our investment returns in respect of that particular benchmark that they've done. It's a very, very complicated test that's been calculated. We do have some concerns in terms of the way that our fund was measured in that particular space. So we do admit that and have previously, I guess, identified that we did have some underperformance in that 6 to 7 year period ago. A couple of reasons for that, particularly in regards to our performance of our share portfolio during that point in time, because we did take out some insurances in the lead up to certain activities that were happening worldwide that we thought were going to impact us. But the other element of it as well is that we have an alternatives portfolio that's included as a part of our lifetime one. And this alternatives portfolio essentially provides you with some downside protection. So where the markets crash, our alternatives portfolio is designed to make sure that those losses are far less significant than certainly something that is a little bit more aggressive. But what this test has unfortunately done, particularly with regards to our alternatives, is actually mark that against a higher level of growth assets. So when we look at the results of that, it essentially has hurt the fund negatively in regards to the performance against that particular benchmark. I guess the one thing I would like to indicate is that, being aware of all of that, and certainly prior to the Your Future, Your Super even becoming an issue in terms of the legislation, we'd made some structural changes to our investment options, certainly in terms of reducing lifetime one, which is a far more effective investment strategy for more people because it does take into consideration your age at a particular point in time to make sure that you're at an appropriate level of risk, no matter where you are in your working life. We've got a dedicated website to the Your Future, Your Super material. So if you actually like to get some more information and understand a little bit more about what it is and what it means for the fund, I encourage you to go onto our website. We've got the website address up there, which will be there for another few seconds so that you can get that through. But the government has also, I guess, produced the Your Future, Your Super comparison tool, which is available on the Australian Taxation Office website. So we do encourage you to go on there and have a look at your investments with us against some other options that are out there. Again, just remember that Lifetime One has been around for 3 years, and that Your Super tool does do comparisons for 1, 3, and 7 years. And I think you'll find that Lifetime One, in particular in the last 3 years, has done exactly as it's intended to do in respect of managing people's risks and still making sure that they get a decent return. I guess with that in mind, if you're an under 40 years of age, and I don't know there'd be too many on this particular presentation today, but I'll go through to the next slide, which actually indicates exactly how much you would have earned in the last 12 months to the 30th of June 2021, and certainly the 3 years since Lifetime One's inception. So you can have a look at those results on the screen, and I think you'll probably understand that there's some pretty good results, particularly in the last 12 months. Those results have been fantastic. And even across those 3 years, those results have been very, very competitive against some of our more aggressively invested competitors. So again, we encourage you to take that into consideration. Have a look on that Your Super tool available on the Australian Taxation Office website. If you do have any questions or thoughts or concerns, really do encourage you to reach out to your local regional manager and ask them any of those questions, or if you seek any further information, we're really, really happy to have those conversations with you. And hopefully, if you have any concerns, allay those and just let you know that we are obviously someone that's been with you for a long, long period of time, and we ask you to continue to trust us as we progress through to the future. Having a little bit of a further look in terms of what that future looks like, we realise that the recent merger with NGS obviously did fall through, which was somewhat of a surprise to us. But just want to keep you informed that we always had a plan B in that regard, and we've always understood that we do need to become bigger to remain competitive. I know the legislative bodies have suggested that funds need to be around 30 billion and beyond that now to remain competitive in the market and be able to look after our members' best financial interests. our members' best financial interests are wholly what we do for. So we will continue to do that. Part of that is that we're still looking for an appropriate merge partner that's going to look forward to your best financial interests. You'll probably see a number of communications from us in the near future and medium that will keep you informed as we step through that particular process. So just please make sure that you are reading those communications. Please reach out if you need any further information in regards to those communications, or if you just need help in regards to your superannuation. We're always going to be here and hopefully continue to service you in the manner that you've become used to. Again, regional managers are available right across the country. I'm based in the Brisbane office, but Justin's in our Sydney office, and we have others that are there available for you should you need it. Lastly, we've got some other webinars that are coming out in the near future that are available on our website at the moment. We do a quarterly investment webinar. Again, that's probably quite topical at the moment, so we encourage you to jump on there and get some further information. There's also going to be a Centrelink webinar. So if you're closer to retirement and looking at that, the age pension in particular, and how you might fit into that particular process, we encourage you to come along with that. Those of you that are interested in aged care, again, there's some further information that's available to you coming out in the future, and we'll be running some further retirement planning webinars for you moving forward as well. Another way that you can actually get some further access specific to your own account is obviously through our member portal, and we've got a copy of a page up there in front of us at the moment. I think this is a fantastic tool. Some of you may not be aware that we actually do still, or do now, have a return of our app. So if you haven't downloaded that as yet, just know that that's available. I think it looks fantastic, gives you some great information so that you can keep on top of your superannuation, make sure your contributions are coming through and those sorts of things. Encourage you to do that. It's available 24/7. You can actually transact on your member portal at the moment as well. So depending upon where you are, you could even potentially make withdrawals from your superannuation if you've done so previously as well. Nominated beneficiary, a non-binding beneficiary. There's lots of different things that you can do. If you do need to contact us, there's that link that Justin's going to put through for us on the Q&A section. So please make sure that you click on that link. Let us know if you'd like some general advice, over the phone advice, or if you'd like to come along and have a chat with someone like Tom. But as always, we're available on 1300 658 776 if you'd like to have a chat with someone in our contact centre. Our website's available there. And if you do have some information that you'd like to request from us, then we encourage you to email the fund office or your regional manager directly, should you have that relationship with them as well. I want to thank you all for coming along this afternoon. Hopefully we've been able to get through any questions that you might have had for us and entertain you for the last hour and a half and a little bit. Tom and I generally don't get to stick to the 1.5, but I think this is pretty close, Tom. Thank you for your time today.
No, thank you, Bill.
Justin, did you have any other questions that you're observing in the
just
background?
Sorry, Bill, just a few questions that come in through the chat box. I know you've been monitoring the Q&A section, but in the chat box, there's just been a couple which I'll quickly just go through.
Please.
The first one is quite an easy one, which I'll answer. Can you please share with us a link to this recording? This will be on our website, I'd say later this afternoon, but definitely tomorrow. So you can go back and watch Bill and Tom's webinar again. And they've been very informative of what they've given you. So there is a few other questions. Julie, so I received an email stating you're currently investing in Lifetime One. What does that mean? Hopefully, Bill, you answered all that in the last few slides because that came in before you spoke about Lifetime One and the performance test.
And I would say, Julie, that we actually are going to reach out to you, having asked a couple of questions of us, and we'll just refer back and just make sure that you do have all of the information that you need. So just touch base with us in that next couple of, or we will touch base with you in the next couple of days and make sure you're comfortable that you have all that information.
The next one we had is, and Tom, I'll direct this your direction. Mm-hmm. What are the required documents to use when you deal with Centrelink regarding age pension, as I'm over 67 years of age?
Yeah, so this is where it can get complicated. The first thing is they'll try and get you to do the application online through a MyGov account. So you need to set up a MyGov account. If you do the old-fashioned paper form, I think it's about 58 pages. A lot of it might not be relevant to you, but they'll be wanting things like, well, they'll need super statements. So if you've got a super account, they want a current balance. If you've got an income stream, they want something called a Centrelink schedule. You've got bank accounts, you've got shares, they want proof of those. So they do ask for a lot of documentation. If you were born overseas, this is one I had the other day, they wanted the ship that you came on. So this guy came from Greece in 1954 when he was 18 months old, and they were asking for the ship, the name of the ship. Now, luckily, we Googled it and we found it. But I mean, these are the sorts of things that they could start asking. So they do ask a lot of information. Yeah.
Right, Tom. Another one is I'm about to turn 67. Having a large amount of cash, should I put $330,000 into super to push it up over $1 million in super?
Well, without saying yes, and just generally speaking, I guess the things you've got to think about well, have you put any large lump sums into super before? And can you put large lump sums in? So you've got to check that off. That there is a time limit of putting that, using that bring forward rule. So once you've used that time limit, well, it's gone. You can't put the money in. And that, well, if you're 67 and you put money into super, well, you can access it again. So it's not preserved. So that's, I guess, a positive that, well, if you put it in, well, you can take it out again. And then the final thing is putting money in from the bank account into super is you're going from an investment, which is obviously very secure in the bank account, to one where you choose the level of risk of how it's invested within super. Okay, so those are the issues that you think about when you're looking to put those monies in.
Worthwhile seeking advice.
Yes, I should have added that, Bill.
In that situation.
Right. And the limited advice, I don't know if the limited advice service can deal with that because it is using those larger contributions. But I mean, we can talk to you generally again, or if you do want to go through that personal advice service, come and have a chat.
Great. Well, there's I think that's about all the questions. As Bill said, the local RMs will contact some of the other questions that are a bit more personal and so on. There's quite a number of people saying thank you for the webinar, Bill and Tom.
I think there's one more question that's just come in. I can answer that one.
Yes.
So that if someone's got a redraw on their home loan, is it counted towards assets? No, it's not. If it's a redraw, then it's not. If the money's in an offset account, then it will be counted as a cash asset. But as long as it's the redraw, then it's not counted towards the assets test.
Thank you. And there's one last comment here. I won't go through all the thank yous and patting you all in the back, but there is one lady here who I know is in the Canberra Goulburn diocese. So it's nice and sunny up in Queensland. She's got snow in the hills down there. So all the different climates are watching in today. So I'll leave it to you, Bill and Tom, to wrap up. Thank you.
Yeah, thank you, Justin, and thank you, Tom, for your time today. Thank you, everybody, for attending today. I'm glad that I've got warmer weather here, and Tom's already mentioned that we obviously have a few less restrictions, than many of you have had. So we do hope that you're actually taking care and getting through that okay. Encourage you to give us a call if you need any further information. And come back and make sure that you stay active in regards to your superannuation. So you've taken that first step. We look forward to seeing you again further in the future.
Thanks, Bill.